This is Rich Erwin of IAM. I'm in Chicago today. It's late June, and I'm here to attend the Morningstar Investment Conference. It's something I like to attend. This is about the fourth one I've been to, and Leanne DeVey is with me as well to take part and to learn from it. We hope to get some investment insights. The conference began yesterday afternoon, and the keynote speaker was a guy named Michael Hessenstab. He is a portfolio manager for Franklin Templeton, manages the Templeton Global Bond Fund. Now that's the second largest bond fund available behind PIMCO's Total Return. We really liked his insights, and I want to share a few of them. He talked about, first of all, what reasons might there be to panic today? And the two that were key were whether the Eurozone comes apart and whether China has a hard landing. Those would be the two concerns that could throw the markets off. So he wanted to direct his comments at that. He said Greece is fiscally terminal and it would take a miracle to turn it around. So there's really two courses that we could go from here. One is a likely ongoing subsidy from the Eurozone countries to try to work things out, which they may eventually never do. And the second would be Greece's exit from the euro, which would be very costly for Greece. He said as far as Italy and Spain go, and now they're bigger countries and they're more significant in the whole scheme of things, he said they're completely different from Greece. Spain started with only 40% debt to GDP before this financial crisis hit. And it's had some housing issues that have been very costly. But they never really were like Greece, starting out with a high debt level of over 100%. They have an issue with recapitalizing their banks. They need to put about $100 billion into that, and that's what their main goal is right now, is to strengthen the banking system. They're going to bring in some external auditors and really figure this all out, and then go ahead and have the government subsidize the banks to strengthen them. Ireland did this early on in the financial crisis, and they've already borne the results, which have been good. As far as Italy goes, they started with higher debt, but their debt hasn't increased very much. They've had responsible treasury activities, so the debt's been stable at 100% debt to GDP. And they don't have a banking problem. Their problem is that they need significant labor reform, and that's something the new Monti government is working on, and there's some hopes that they'll make progress along that line. He said that this overall European problem may be a blessing in disguise. It may lead to a fiscal union, which is needed to make the Eurozone work. Germany and France are closer to a compromise than they've been, and should reach something in the next 2 years, he thinks. And there'll be no success in Europe without it. So he holds some hopes, but there's some issues bearing watching. As far as China goes, for a hard landing to occur would require a major policy error, over-tightening. But that's unlikely to happen since Chinese leaders are already loosening, adding liquidity to the system, loosening on the credit controls. So, and they're doing a reasonable job at that. If there were problem could be if there were a banking crisis, but he thinks that's unlikely since they recapitalized the banks within the last 5 years, and the government has $3 trillion in reserves to use to support the banking system. So that's less of an issue. Long-term issues, unconventional monetary policy, the banks of the world printing money. That will have to be managed very carefully. It will need perfect timing to reverse, in his opinion. So down the road, a few years, not right now, that'll be an issue worth watching. Currency debasement. With the amount of money that's being produced in the U.S., he feels there is a chance that the currency will weaken over the years. Particularly, we have very high pension and healthcare obligations that will come into impact, the largest of all the developed nations. We need to reform those. So as far as China, looking to the future, we need to look to increasing labor constraint. Their one-child policy will have an impact, and there'll be less of a labor force, which means labor costs will go up, and we'll all feel it around the world. But the good news is the higher wages that Chinese will receive will increase their consumption of goods, and companies that supply goods to China will do well. Okay, so he was asked where the largest opportunities were, and those were, in his mind, in the emerging markets. He's a bond manager. He said some of the best credits in the world are now emerging markets. He gave an example of Indonesia that had 100% debt to GDP and now down to 25%. And he feels that their currencies will be a little stronger than the developed nation currencies. So anyway, that's the vision for the future, that we'll probably work through our problems. It'll be a while in the coming, and there'll be opportunities out there, but we have to carefully look at them and sort them out and position ourselves to take advantage of them. So that's the first day. We'll give you more later on. Bye.